Hello, everyone, and thank you for joining us for this session of Impact Insights. My name is Lucy Hoffman, and I work with the Impact Trust. In today's session of Impact Insights, we'll be looking at the role of intermediaries in the impact investing ecosystem. Impact Insights is hosted by the Impact Trust, a nonprofit organization dedicated to growing and maturing the impact investing ecosystem to realize innovative social and environmental solutions to developmental challenges. The Impact Trust has an award-winning team and global task force of experts with a long track record in social impact investment in both South Africa and beyond. Our team, under the banner of NEXI, also founded the first publicly regulated social stock exchange board, the Impact Exchange, or IX, in partnership with the Stock Exchange of Mauritius. We designed the Impact Insights webinar series to equip investors, entrepreneurs, and advisors in the impact investing space with key tools and guidance for success. To sign up for notices on future webinars, go to www.impacttrust.org.za and add your email address to the subscribe at the right-hand side of the homepage. Today's webinar will be 1 hour in length and includes a Q&A session at the end. All attendees will be on mute throughout the session. If you would like to submit a question during the presentation, you can do so by typing them into the toolbar on the right-hand side of your screen under Questions. You can also submit your questions via Twitter to @ImpactTrust. The webinar is being recorded and will be made available after the live version on the Impact Trust website. Again, www.impacttrust.org.za. Before we begin today's session, I'd like to welcome our guest presenter, Andreas Zeller, the Managing Partner of Open Capital Advisors. Andreas covers East Africa from Open Capital's Nairobi office. He began his career at a startup technology venture, for which he managed operations and worked on capital raising efforts. Andreas then entered investment banking, working first with Citigroup in New York and London, then with Credit Suisse in New York. During this period, Andreas advised clients in the technology sector on equity, debt and mezzanine capital raisings, mergers and acquisitions, and company restructurings. Andreas then left Credit Suisse to join the infrastructure investment team at the International Finance Corporation, IFC, part of the World Bank Group, first as term staff in Washington, D.C., and then as a consultant in Nairobi, Kenya. At IFC, Andreas was responsible for analyzing, structuring, and executing double bottom line investments across Africa, Latin America, and Eastern Europe. Andreas, thank you so much for joining us today. Over to you.
Thanks a lot, Lucy, and hi, everyone. Let me just take over the controls of the webinar and get a presentation up in front of me. One second. Great. I wanted to start and speak overall for about 30 minutes here, a little bit less, and pass it over for questions and answers, but start with a brief introduction of who we are at Open Capital. And thanks, Lucy, for the background. To move over to the Open Capital side, we came here to Nairobi about 3.5 years ago. And we came because we found a number of impact investors, more broadly SME investors, who were interested in placing capital in the region but weren't able to. And the reason, at least according to them, was that they didn't find businesses that were prepared enough for the growth. And true enough, here you have many entrepreneurs who do have a wide market opportunity but often haven't thought about what a path to scale would look like, what a forward-looking plan would look like, what sort of distribution network you would need to accomplish that sort of scale. And so we came to form Open Capital to advise those high-potential businesses on their growth. We saw quite a bit of success with that early on and decided to expand our platform to include 2 other types of services. Increasingly, investors were asking us, what happens after we invest? And we came in to advise their portfolio companies on accelerating growth as well as on the pre-investment side, helping investors structure new financial products, perform due diligence in the region, and in general move more capital effectively to companies that needed it most. We then expanded to what we call market research and innovation as larger investors were hiring us including a range of different parties, from donors to groups like the World Bank, IFC, CARE International, and others, who wanted us to do different innovative things still involving small and medium-sized enterprises. For example, investing in an entire value chain, looking at a value chain like agribusiness and working on both the production side as well as processing and distribution to remove blockages and enable more growth in businesses. And so over the last 3.5 years, we've seen quite a bit of success on that platform and really grown with the markets here. We've now worked on 72 different engagements to date. We have a full-time team of 12 people, all based here in Nairobi, and we've worked across 7 countries in East and Southern Africa, of which Kenya, Tanzania, Uganda, Ethiopia have accounted for the majority of our work. And so, what I wanted to do here today is describe a bit more about how we function as, I suppose, what we're calling an intermediary. We tend to play many different roles, but fundamentally, the goal is to take the most high potential businesses that can transform markets commercially and sustainably, but also have tremendous impact, and help them grow, help them achieve that growth, both through financing as well as careful preparation, and also in many ways accelerate that growth. We aren't coming in as incubators, but we're coming in for businesses that already have a phenomenal entrepreneur who could use the help in terms of all that's involved in structuring a successful business, be it the planning side, be it the internal structures and corporate governance side, and many more. What I wanted to do today is address a specific case. And this case is on one specific client of ours, but I think is representative of a number of different SMEs that we'll engage with, and walks through the process that we went through to bring the business to an investment-ready position, and a position where it was ready to grow very quickly, which then ended in a successful investment, 2 rounds of investment actually, and now the company is growing very well. I think what's unique about this business is it was a very early stage opportunity led by a very successful entrepreneur. Now that really is a requirement of ours. We try and find entrepreneurs who themselves have a great deal of technical experience. They might not know everything. They might not know how to make a complex Excel model. They might not know what quasi-equity or convertible debt is, and that's fine. In this case, our client was a doctor with 20 years of experience, substantial experience across different sectors, who very well understood what the mass market needs were for clinics. The reason we partnered, and especially at such an early stage, is because we saw potential for this model across Kenya and East Africa. So I want to walk through this as an example of the type of support we provide to SMEs to enable them to become investment ready. And then at the end, talk more specifically about what that investment process was like with various impact investors to bring the business through to financial close. So just to start, I wanted to describe a bit the process, the first process, in fact, that we have with all clients, which is designing a scope that fits best the client's needs. And in this case, the goal here was to design a scope that, again, didn't replicate any of the skills or efforts of the entrepreneur and his team, but rather complemented it. And what we saw is, well before we could reach out to any investors, we needed to first design operations and create a very clear path to scale. What that meant is designing a clinic business model and operational plan, and assisting with early implementation. So the idea there was, it wasn't enough just to say that our theory was that a mass market clinic, in this case, was needed across Kenya and that the market was firmly in place. The requirement was, how could this be commercially sustainable? What sort of prices would you have to charge for services and products and pharmaceuticals and across the range in order to generate enough profit to make this attractive to investors and sustainable over time and scalable? First thing we did there was study the market, and we realized we had to determine very clearly what a go-to-market strategy would be, and then after that, create a replication strategy. Again, one clinic wouldn't justify the level of investment that was of interest to the entrepreneur, nor the longer-term growth plans. And what was really critical is to prove from an operational standpoint how this clinic could really achieve 10, 20, 70 clinics over time as opposed to just one. Second after that was to figure out a financial structure that would match that growth profile. So again, trying to design a financial model that quantified the growth plan that we'd laid out. Prioritize the opportunity very clearly in terms of how many clinics over time, what sort of costs we expect to incur to do it, both direct costs as well as indirect marketing, all those. what sort of capital expenditure up front, what sort of scenarios are most likely and why. And then based on that, evaluate the investment requirements and recommend the type of financing structure, whether it be equity, debt, or anything in between, that the clinic network most needed to grow. And then ultimately develop a term sheet that tried to better articulate the financial proposition to investors. And all this is really critical to try and make the process as efficient as possible. Last, we helped the business manage the full investor outreach process. What we found is if we finished our work with bullet point 2 here, the business would still struggle. The reason is many investors, despite their best intentions, will come with 50 to 100 pages of term sheets and documentations, which again, this individual entrepreneur would probably, in fact, was overwhelmed by. And the goal here is to start off by presenting and preparing investor documents. So start off with a teaser just to describe the business high level, then a full presentation, then a financial model and everything in between. And then manage a full due diligence process, working closely with the company, but handling a lot of the investor requests that the entrepreneur didn't have the time to address, given that he was very busy with operations. And then assist in negotiations, help the client understand the terms that were being proposed, what was good or bad for the business, and on what terms he should negotiate. And then work straight through the disbursement of capital until the check is actually in the company's bank account and the company can grow. So that's how we outlined scope, and this was a process of working with the client to understand exactly what had been done and what was left to do. But again, the goal was to create a process that would take the client most efficiently to investment, but also ready the client for growth thereafter. I want to move on to the next slide here, and what I'll do is I'll try and spread out the screen so everybody can see every word on it. I want to talk briefly about the client's market. And this client was targeting a very specific market, which is true of many frontier countries like Kenya, but very much applicable across Africa, which is trying to provide a healthcare offer to the mass market, not the poorest of the poor, but a segment of still economically challenged groups, excuse me, across Kenya initially, who earned just enough to afford services, but weren't provided with services that met their needs. What we found is this was a very fast-growing middle class that was actually able to pay for healthcare services, but yet who didn't really have all that many options in the market. They had public options, they had a few private options, but nothing really was tailored to their needs, despite the fact that the amounts that they were able and willing to pay, which we estimated was about 1,500 shillings, or about $20 US, was certainly adequate for private sector providers. This is a segment of the market that many companies have targeted very well. Companies in Kenya like Equity Bank and Safaricom have done a phenomenal job targeting this market and offering services that are both affordable and help those consumers develop. And so we had a very good perspective on what the market was. Flipping a slide, we looked very closely early on at who the competition was, who else was in the market. We did this by calling various different providers, visiting various clinical options, trying to track and aggregate information, understand based on public sources such as the Ministry of Medical Services what was available. And we found that you just didn't have many options to suit the needs, especially on an outpatient basis for many of these consumers. And so this reinforced the argument about what we were trying to build with our client. Moving on, we took that market argument to try and design a very specific model. The idea here was to be quite innovative, to try and combine 3 areas that we found were most needed at the mass market level, which are quality, low price, and accessibility. If you don't have quality, surprisingly, or I guess not surprisingly, any sort of consumer is going to be disappointed, no matter how much they have to spend. But at the same time, the option has to be very close. It can't be that you get on a bus for 70 kilometers if you're sick just to get to a reasonable option. At the same time, the price point has to cater to the economic realities of the customer target base. And so the goal here was let's serve a market that doesn't have many solutions, but is very big, and let's serve it on a high volume, low margin basis. Let's try and innovate in the sector and provide a quality service, the likes of which are not available more broadly. Once we define that, we then tried to figure out, well, what does scale look like? If, assuming we are able to commercialize this, how do we actually grow? We realized that, upon launch, it was pretty critical to pilot with a smaller number of clinics. So the idea was, let's launch within a certain specific geography. let's target very standardized clinics that can deliver the same services, the same quality level without variance. Let's develop then the basis for a national network that can scale more rapidly over time. For example, the IT systems, the management structures, the overhead, the quality assurances, the approvals. Everything's required to build a much broader network while we're doing the pilot. And then let's enter a growth stage, which we can already project will reach X number of clinics over time, given a certain amount of resources. And then the goal is then over time, more broadly, diversify services where necessary. So add a maternity angle to the service, add an optometry service, many different services using the same distribution network. And the reason we were mapping this out and looking 7 to 9 years out is because we wanted to attract long-term partners. We wanted investors who understood not just where the business was today, but where it was going, and who could give us enough capital to really build a foundation, not just fund a couple clinics. Moving on, as you probably have realized, this is essentially a double bottom line business. It's quite, in many ways, the definition of it, because it's trying to target a commercial return while still realizing impact. But at the same time, the client wasn't sure how to do that. And one of the critical aspects was trying to help define impact metrics to articulate that mission, to better define it and track it over time. And in this case, the client was really torn. The client's objective was to serve the mass market with a service for which they would pay and make a margin out of it, be sustainable and scalable. But he wasn't sure how to track livelihood impacts. And so one thing we looked at very closely is what is the sort of benefit this model would have on the millions of potential customers over time? What is the benefit of spending less for better health outcomes? What's the benefit of not traveling as far for health? It's a clear qualitative answer, but very difficult to quantify. And so we used different metrics to try and understand better how that would look over time. And then finally, we tried to develop investor materials that articulated everything we'd learned. The goal here was to develop materials that showed clearly the market opportunity, but also demonstrated the level of work and preparation that had gone in. And so we developed something like a 70-slide investor presentation, which effectively was a business plan. It had that same level of detail, presented the market opportunity, the business structure, the operations, the clinical layout, the architectural plans, everything else that you'd imagine. And after that, we identified a group of experienced healthcare investors to try and approach to manage the most efficient process possible. The idea was to find a partner who understood well the sector, could understand the double bottom line of the company, and also understood the long-term growth expectations. And ultimately also was a good fit with the entrepreneur from a personality perspective. Especially for early stage businesses, what's really critical is you have a fit on all those levels. Even if the investor ends up being based far away, be it a global investor who's investing locally, you want to make sure that the investor brings more than just capital, and also understands the sharing of responsibilities. And so our investor presentation set up that ask. We wanted to make sure we also define the type of investor who would be a good fit based on the business fundamentals. So what I wanted to go through here is just a review now of the actual investor process. I've mentioned all that we did to prepare the business for the investors, be it developing the business model, the path to scale, the financial model, the investor deck, and teaser. But when it came to actually approaching investors, we found the process was very similar as it is across the board, where we sent out a teaser to investors, a very short document that saved time, made it very clear what the opportunity was, still with enough information to allow the investor to express true interest or not, and then enable them on their side to have a concept review, where just a high-level screen, understand whether the business was a fit, and then come back to us with true interest. And we were able to identify a few different partners, not many, but a few, who really were genuinely interested based on that teaser. Then we entered due diligence, where we sent all the full materials. We enabled the investor to conduct the full due diligence. We helped walk them through every step of it, be it explaining who we met in the market, how we did the research, what basis for the assumptions were, what the growth prospects were, ending up with a situation where the investor internally was able to develop an investment memorandum and a document they felt comfortable presenting to their investment committee, and then ultimately received term sheets, presented our term sheet and discussed theirs, and came together closer on what terms for this investment were. That then led to an investment committee approval process where the investor finished their materials, finished negotiations with us, and then went to their committee to present the opportunity, which at this point, we'd really narrowed it down to one investor who was the best fit for this particular business given their experience. And after success at that level, we then entered several other stages, documentation and otherwise. And then ultimately, as in many times, the next step after that would be portfolio management, where, in this case, we were able to agree to continue supporting the client post-investment. In some cases, the investor will do that themselves. But in this case, the idea was, now let's help on the implementation side. Let's help accelerate growth. Let's make sure that all the projections we laid out are achievable. And the goal there was also mitigating risk for the investor. The fact that we had a very qualified team on the ground gave them some comfort that, even though they didn't have those resources, every detail would be worked out, be it on the business side, on the reporting side, on the path to scale. Everything would be worked out quite carefully and achieved. So ultimately, what I wanted to do in this brief presentation before moving on to Q&A was go through a bit of a very standard process. This is a process we've now done dozens of times across industries, across types of businesses, some later stage, some earlier stage, all with some sort of impact implication, whether it be through creating jobs, whether it be through environmental benefit, through innovating in a sector like healthcare, education, or agribusiness. And in all cases, we spent months preparing the operations, preparing the investment materials, then to go to the market to investors. And in almost all of those cases, we found that the time we spent at the pre-investment side to get to that point was very beneficial in enabling a more efficient investment process and finding the better partners. And then in almost all cases also, as we look back at our former clients, those clients have then been able to implement on those strategies. Obviously, there have been variances and pivots as they go, but been realizing excellent results because, again, we went through the rigor with the entrepreneur, ourselves and the entrepreneur, of designing that process. And so what I wanted to do is conclude there. It's been about 25 minutes, and move on to Q&A. And really, I'm happy to answer anything, both about our experience as Open Capital or within the bounds of confidentiality, obviously, this particular client example. So Lucy, let me pass it back to you.
Thank you, Andreas. We'd like to move now to questions from the audience. We received some great questions as Andreas has been speaking. I encourage all of the rest of you to join the discussion and submit your question at any time using the question box on the right-hand side of your screen. So the first question we have is, how does Open Capital get paid for their services? By entrepreneur, through equity stake in the company, or through investors?
And that's a great one. We have a fairly unique model. As I'm sure everyone on the line understands well, we can't charge a typical consulting fee to a small or medium-sized business, especially in East Africa. It just doesn't work, and it never will, with very few exceptions. And so what we'll typically do is try and defer as much of our fee as possible on what we call a success fee, which means we're taking 70 or 80% of our total fees for the 6-month or more engagement, and deferring it upon a capital raise as a percentage of the capital raise, and only if the capital is raised. So yes, we will always have a fixed fee as well, which is something that we have to talk through with the entrepreneurs, but we found they're very willing to pay. But we also are able to share risk. Now that's, for investors, it tends to be more of a fixed fee basis with milestones, given that they've often already invested. But that's all based on scope and milestones, and we try and estimate it based on team time and intensity.
Great. Another question here is, how do you work with your various clients? Do you develop in-house expertise, or do you work with external consultants?
We work completely internally. We're currently a team of 12, and we'll shortly be hiring to expand our team to about 16, and then more after that. The idea is we need to maintain a level of quality which often isn't present in the market. And our team members are East African, they're American, they're European, but they bring backgrounds from everything from senior management roles in SMEs in Kenya to accountants to consultants. Lady on our team was at BCG in the past, to my background. The idea is bringing that skill set together. But we don't associate with external consultants for most of our work because, again, what's so critical is forming a relationship with client, appointing a full team that stays very consistently available for the client, no matter how long the engagement is, and again, ensuring quality throughout.
Great. That actually closely relates to another question that we have here, which is when you're first starting, I think this is probably coming from somebody who's looking to start their own similar type of organization. So when you were first starting, how many people did you start with, or what is the minimum number of required staff to really establish oneself as an intermediary in this space?
I think the second half of that question is impossible to answer. It really is dependent on who the people are, what the market is, and how you're trying to serve it as an intermediary. There are many different types of intermediaries who do many different things. From our perspective, we started with 4 partners, a mix of Kenyans and, again, international people who brought different backgrounds. And I think what was most critical there is the fact that we did bring different backgrounds from the investment side to the consulting side to the accounting side, because that combination of skills was what enabled us to serve pretty much all the needs of the clients we met. So clients here don't want to hear that you can solve 1 of 3 of their problems. You have to solve all 3 in order to bring them truly to a point where they can grow and receive investment. So I would say it really is dependent on the market. What's really critical is the level of intensity of work. We came and we worked very hard, many long nights, and what was really critical is we had to deliver to the client what we promised. And I think that's what's kept our success rates very high on the investment, and that's in turn what's helped us scale.
I think from the same person, in the East African context, what would be a suitable legal structure for an intermediary, profit or non-profit? Or is this something that you even thought about when you were establishing yourself?
You know, from our perspective, we were very focused on only being a for-profit. The way we view impact is absolutely from a commercial first perspective, insofar as we won't work with a business that is focused more on impact than on returns. The reason is, in our opinion, they often won't be sustainable. That is, if they're pursuing a for-profit model. We wanted very much to instill the type of incentives in our team from a bonus perspective and so on to do the best work possible to achieve the best results. And in our opinion, the best results are when we can help a client grow to a position of scale where they can truly change an industry. Taking this client as an example, we only engage with the client because we do firmly believe this client can reach 70 clinics in the next few years. You know, they're already doing phenomenally well with 1 clinic, but the goal isn't just 1 clinic. It's really changing an entire system. And in doing that, we see excellent returns from a financial perspective, both for the entrepreneur and the investors. We also see tremendous impact more broadly.
Great. Another question here. Is there a minimum level of raise below which you won't consider the mandate? And do you have issues in finding raises sufficient enough to scale or cover your costs?
Another excellent question. You know, I would say yes, certainly on the minimum size. We are best suited for businesses looking to raise between about $200,000 of capital and $5 million of capital. And yes, there are exceptions on both sides, depending on who is supporting the investment. In some cases, we've raised $20,000 for a business that was shortly after poised to raise about $1 million, given their level of growth. And so we will be flexible on that, but the key, as far as we're concerned, is trying to support businesses that have the potential to grow and scale. That really is the most critical element for us. Whether it's been around 50 years and they're already generating $1 million a year of turnover, whether it's a 2-day-old business like this example was, we're happy to help them so long as we see that type of scale potential. In terms of covering our cost, you know, I think diversification is important. The fact that we have different types of clients, different, you know, be it investors or SMEs across different industries. It's important not only from a cash flow perspective, but it's very important for developing our own knowledge. And we've become very knowledgeable because we have advised investors looking to invest in the space and businesses seeking investment. I would say, you know, early on, a majority of our referrals on the business side came from investors who saw opportunities but weren't able to invest because not all the pieces were there. They saw the potential, but they weren't able to invest yet, so they referred it to us. And that was a phenomenal way to build our own pipeline, but what we found out is very few people were doing the type of work we were in East Africa at this sort of quality level or deliverables level. And so really it became a word-of-mouth question where the next 30 or so clients came from entrepreneurs whom we'd helped grow 5 times, 7 times in terms of revenues or profits, raise a couple $1 million of capital. And that success translated over to entrepreneurs who are in their networks across different industries, across different ethnic groups and countries, and you name it. And that kind of scale kept us growing to the point where now we don't do very much proactive marketing. We're very much focused on quite a full portfolio at any given time of client projects, largely driven by entrepreneurs that who are in the networks we formed as we've traveled, and the sectors we've investigated. We've done quite a bit of research on the various sectors to understand who we believe is well poised for growth, and try to engage those clients, even if they aren't the names that are in the international media.
Great. Another question here. Can you provide any detail on the process employed in identifying and measuring relevant metrics in the case study example? How is it possible to inform due diligence in cases where data may be scarce or unreliable? And are projects in data scarce sectors or countries or economies automatically non-starters for open capital?
Well, to answer the last question first, no. We just finished our first project in Madagascar, an incredibly challenging country. We've done a number of projects in Ethiopia and Tanzania and Uganda. We've done 3 in South Sudan, which is still coming out of many decades of civil war. And we found that it isn't really about the data availability. It's about, first and foremost, the entrepreneur whom you engage, the way you structure the engagement, and the way you approach data gathering. And we found that there are many ways of gathering that data. Yes, are intensive. They require a lot of in-person conversations, interviews, a lot of redundancy, testing different sources, testing different facts. But at the end of the day, that's how most successful investors we've seen have been able to overcome that lack of data. Now, in terms of there are several parts of that question. In terms of the impact specifically, which was your first part of your question, that is, we could speak about that for hours. It's another whole challenging piece of the business we operate in. Question is, how do you define the metrics? How do you then track the metrics over time? How do you even understand who your customers are in the first place to figure out what metrics to choose? That all is a part of the initial work we do in sitting down with an experienced entrepreneur and learning about their experience, understanding their hopes and the mission in terms of whom they seek to address, and then asking the right questions, doing the right analysis. In this case, for example, the client has a patient intake form, which itself gathers quite a bit of information about the patient, which is then trackable over time as they go, especially in terms of health outcomes, as well as income level. And we were able to glean quite a bit of information and understand the target market very well based on that. So, it all comes from a fairly intensive process with close iterations with the client. And honestly, a very critical point there is that we all live in this market. Every day we're involved in it. We, our networks have expanded. The Kenyan staff on our team have lived in this market their whole lives. The more we travel, the more connections you make and understanding you get. And I think that sort of information, is very important in covering the basics in terms of understanding impact as well as the customers you're serving.
Okay, we have one more question here, unless we get another hand raised. When assisting social enterprises in this capital raising process, how do you think about the cost of capital and pricing? Is it different from traditional markets, or is there some sort of discount in the cost of capital assumed because of social or environmental impact?
That's also a great question. It really varies by investor. Yes, it varies dramatically. From a technical perspective, valuation is a very difficult thing to do in these markets. A discounted cash flow value, which is an intrinsic method of valuation, is difficult to perform because of the uncertainty of cash flows on a projected basis, and even more difficult because no one really knows the right discount rate. It's not like you can apply a simple weighted average cost of capital and do the math that you would in developed markets. I think the challenge here is it's very much linked to investor expectations. And what we'll find is many commercial investors here are looking for IRRs in the 30% range, if not more. Social investors are often willing to see a different structure to that, but ultimately are also looking for high returns. Yes, in many cases it's different, but whether they're now willing to be more patient, wait for exits instead of dividends, and wait out a client's growth cycle, or more impatient in terms of structuring debt with early repayments, it's all really a function of the type of investor, and there are many investors. And one of the reasons we've tried to expand our investor network as broadly and work with as many investors as possible is that we want to make sure we find the best fit from both a approach, mandate perspective, as well as a returns perspective.
We actually got one last question. So last question is, what can a social enterprise do to prepare to engage with an intermediary such as Open Capital?
We meet many who come with just an idea, and we do engage some with just an idea. It isn't as if we don't engage pure startups, but we do apply a different screen. And what I would say is so critical is really to advance your business model as far as you can until you reach a point where you really have a strong story to tell and some very hard facts to share. What I mean by that is to me, it isn't effective enough if you come with just a story. I want to know that you've put in the effort to make the phone calls, to visit the shelves on the supermarkets, to speak to partners in the value chain and understand exactly how your product would fit, unless you've already piloted and are starting to make sales. And it doesn't have to be written down in a lengthy document. In fact, we've had people come in who haven't written anything down at all and don't even really know how to use computers very well. But their experience and the knowledge they've aggregated tells the full story. And when we ask the hard questions about, how are you going to make revenue? Why would customers buy from you instead of somebody else? How are you going to price your product, and why would that cover cost? We want answers that are well thought through. And in most cases, if you're serious about a business, you'll put in the time up front to invest in thinking through the business even before approaching an intermediary. And we expect that level of thought. In many cases have told clients to go back and think through various elements before approaching us again. Because ultimately, from our side, we're taking risk as well. We want to team up with a business in whom we place a lot of certainty that they'll be able to raise capital after our engagement. And we take a lot of risk from a fee perspective as well to make sure that happens. So, I would encourage entrepreneurs to do as much work as they can in thinking about both tomorrow as well as the path to scale, and then approach an intermediary with a very specific ask. I don't have a financial skill set, so I'd love somebody to come and help me work through an investor process. Or, I don't have knowledge of a particular sector. Those sort of questions.
Okay, we actually had another question. This is great. We're getting a lot of participation in this webinar. Do you ever feel the pressure to compromise your idea of an impact investment in order to take on a deal? It actually appears as if Andreas has lost his audio. So that question we may have to send over email. I'd just like to say thank you all for attending. These have been some great questions today. If we didn't get your question, you may send them to info@impacttrust.org.za. I'd like to again thank Andreas for presenting today's session, and thank you all for your participation. We look forward to having you on our future webinars. Goodbye.